Welcome, folks. This is a market review for EURUSD. So today we had plenty of setups. There's a plethora of setups that we had today. Here we had the 7 and also 2 to 3 silver bullet setups. So today there are textbook entries which are supposed to take as trades. I want to show you how we frame the entries. So this is yesterday's low right there. We had at 2 like this, and then price did not take this low as expected. So this would have been a good trade for longs, but since it did not do that, well, if you ever see today I'm going to teach you buyers. So signatures that price has left behind. So if, for instance, we had this low and this low, which are relatively equal. So what does that mean? If price came all the way from up here, came down, and it did not take this low, that shows that's going to a premium once more, and then it will come, then take these lows. So if you ever see price coming to a certain area and then reversing, like it has repelled from that area, that shows that the likelihood of price getting back and taking out the lows or the highs, there's a high chance of that happening. So we had 2 trades here. So the first trade would have taken was this sell from there, which was around the London Open kill zone. So this is a silver bullet entry, which was to target the sell side down here. So I'm going to mark. Always make sure to note the midnight opening price, which is that. So if you mark it like that, you would either short the market close or above the midnight opening price. So this is a premium array. So if, for instance, if you take a fib, anchor it there to that low and to that high and that low, 50% of this dealing range, that when price is, you don't need an indicator to show you premium and discount. You only need a Fibonacci fib to you set your fib. Let me show you the settings so that you can also set your fib where I set mine. So as you can see, these are the settings. So you need the 0.5, 1, all these. You may opt to use them or not use them. Some of them are used for protractions. Okay, we'll teach about protractions later. So if you take your fib, anchor it to the high, to the low, and the low, 50% means that this range up here, let me illustrate further. Let's see from that, let me mark that as, let's leave it, yeah, see that, then we have this from there all the way down to there. So you may ask yourself, why this high and this low? This is because this is the dealing range. This is the range that we are in at, and this is what we'll be using. So let me make this more. Then I have discount. So the one that's shaded red, it denotes the premium. Is when price goes into a premium, we expect smart money reversal, which is selling short at premium and offsetting the position in a discount. So when price was going up, there are two things that were happening. It was going to a premium, it took out this high, and then we had, you see, we had this breaker, low, high, low, higher, high, which a breaker is basically low, high, low, higher, high. This high has taken out the buy side right there, so there's no need for price to go up there again. So we had the breaker and we were in a premium, so we were supposed to short from this. Now let me get rid of this. Now if you could, let's say, let's talk about protractions. Anchor it to, okay, let's not talk about protractions today, because we use protractions for targeting, but today we had these relative equal lows, which were the target for the silver bullet. So we went to a premium close enough to the midnight opening price, and right there now is where we could have framed our entries. So if we normally take our entries on 1 minute chart, so let's go to our 1 minute chart. So as you can see, price went up, leaving sell side down here, and eventually these are relative equal lows. So while you are here, this is at 245, heading there, it's close to London Open, and if you can remember, the kill zone is between 2 and 3, so we are within the kill zone, within the silver bullet. So this was a good entry. Price came down after taking this high, as you can see, took out that high, broke lower, swing low, taken right there, and then we had this move up. So we had a gap right here. So we had a volume imbalance. This is a volume imbalance, and we had a gap from this high, from this low of this candle to the high of this candle. So price came back in. This would have been your entry, but if you had the hindsight of price would likely reverse from here, you could be selling short right here, but it will take you some time to believe, or to believe that this could work. You don't have to wait for a swing low to get violated for you to get into the market. Then you just wait for a fair value gap and then you enter. So we had this order block here, that could be your entry also. So as price was coming up, you could have entered short right there. So this is a smart money reversal. So your shorts could have been like this. Your stop loss, you could place your stop loss right there, but it is well enough because we had the order block and this is a swing high. So always have your stop loss protected, aiming for that low. So this was a 5-hour trade, 5.32 trade, and price played out nicely. So before you place any trade, you should know where to take partials, where to, if price gets to a certain point, where to go break even, when. So those are the kind of things that you should be knowing by now. But for the folks that are new, if let's say this low gets violated, this one, so if it gets violated there and you entered right there, and then you had this low taken out, you could now bring your stop loss to break even. But sometimes it is wise not to rush your stop loss. Just let the trade play out, because it might come, take you out, and then move in your favor, which is sometimes very it's not a good feeling. So this was a 5-hour trade. So if you did not get this trade, there was yet another trade after the buy side, the sell side has been taken right here. So this is around 346 there. So after you've seen the sell side being taken, you could be framing some entries down here. You could either be buying there or there, but to be conservative, you see this swing high. So a swing high basically means, you see this candle, it has a lower candle to the left and to the right of it, so that becomes a swing high, and the opposite is always true for a swing low. So we had this drop down, like this. So we had the swing high, it was taken here. So we had a fair value gap right there and another one there. For you to get into this trade, you have to incorporate this imbalance, because price may visit this imbalance. So you have to incorporate that if you are entering long for that. So that would be your stop loss, and then aiming for this high right there. So this was a 2-hour trade, but if you had the hindsight of down here, you could have entered your position right here and put your stop loss right below these lows, and anticipate for a run high. So this was a good trade which happened during the London kill zone. So basically there were 2 trades there. So during New York Open, we had these lows taken out right there. So you could be going long right here, swing high, fair value gap. So what do? You enter right there. Your stop should be below there. So eventually you learn how to enter right here, because if you enter it takes courage and a great deal of convincing for you to go short below all lows and going long. Going long below all lows and going short above all highs. So for this, we took out this low. You see, these lows, they were taken out. So it's simple. Whenever you see a low taken and time aligns, time is the key factor here. So whenever you see a low being violated or a high being violated, you as a trader, you should know that you could have some entries. So don't just guess it's going to reverse, not going to reverse. So you should have narrative of where first price is likely to go. So we had these highs right here. So this was a good target for this. So we had a breaker right here. So low, high, lower, low. So extend this candle, the up close candle, the most up close candle, the one that closed above the others. You could have an up close candle here, but this one closed above the other. So you use this one. So you extend it through. That's your breaker. You could be going short as price digs into the breaker. We had an inversion fair value gap right there. So there are lots of things that you could use as your entry. As you can see, price respected the inversion fair value gap. So you can inverse. You see, it wasn't respected right here as price was going up. So as price is coming down, this would act as support, real support. We had a breaker, an inversion fair value gap, and the gap itself. So when price comes down, you could be going long right there. So this was a nice one, and this did a very good risk to reward, aiming for these highs. As you can see, that is a 10-hour trade which you were to take. It went beyond 10 hours. If you could have held for some time, we went about 15 hours. It is a 15-hour trade. So what I'm trying to teach you is aim for the low hanging fruit. What is a low hanging fruit? This high, there is buy stops. Someone traded their stop loss from up there to here. We had this gap. So for targets, I told you yesterday, you either aim for highs, lows, fair value gaps, aim for order blocks, which acts as a magnet for price. So, but you should have time being the factor, being the number one. It is, as I always say, it is time and then price. So whenever you're taking a trade, first consider, is it the right time for me to take that trade? What has it done? So for instance, here we took the sell side. So it was an obvious setup for it to reverse. So we were supposed to go long right here and anticipate taking the buy side right here, which happened right there. And this was a good trade. Right now I was framing some entries from, you see this, after this high has been taken out, I went short right there, aiming for this low. This is a trade that is currently going on. I sent it to my Telegram group. So if you'd like to join, you can comment down there. I'll send you a link for you to join. So today we had 3 trades which were valid, and if some of you saw this was quite profitable. This was a good day, and you see, for you to be in this game for long, your stop loss you don't need a tight stop loss, but at least something that is, you don't risk the whole account for a trade that you don't even know if it's going to pan out. So for you to stick in this game for a longer time, you have to know where is price going, why should it go, when should it go. So time here is a factor. As I told you, between 2 and 3, which is always on New York local time, there is when your setups will form, and when they form, there will be signatures of why they should form, why they formed, and so on and so forth. So today we had a total of maybe, let's say, 30R. Yeah. So these are trades whereby if your stop loss get hit, you could easily go in back again because your risk is small, and you're not aiming for something that is overzealous, something that is not realistic. So you're aiming for something that is near the low hanging fruit, which is the highs. And by the way, if a high gets taken out, there you should be taking partials. If your broker allows for that, you should be taking partials right there, and there. You should be offsetting your position as you head upwards, because no one is sure the price will go up here. We don't know, anything can happen and it reverses on you. So you should be taking partials. You know where to take partials, when to trail your stop loss, because at the end of the game, at the beginning of the day, you have to protect your mental capital and then your account, which is your capital, trading capital. So you should be able to know when to go to break even. So now, for instance, for this trade, if I was to go to break even, I'll go to break even after this high has been violated right there. I'll go to break even to protect my account, and then if price goes above this high, then I could start trailing my stop loss, but not too close to where price is. So I'll trail my stop loss, taking partials, and so on and so forth. So you should be knowing these things. So yeah, those were the trades. There was a nice trade on gold today. Let me show you. So let's go to 15 minutes. So during the London Open, which is in reference and in alignment with the kill zone, price went up into, as you can see, we had now there's a difference between an imbalance. This, from these candles low to these candles high, that is an imbalance, but the space in between these two candles, that is a real liquidity void where no trading took place at all. So if these candles, the wicks overlapped, that is what we refer to as a volume imbalance. This is just an imbalance where price, there was actual trading that took place, but the candles did not overlap. That's an imbalance. But this, the space in between the candles, no wicks, no nothing, that is a real liquidity void. So I was watching this and I marked the two. Whenever you see there is an imbalance and a volume imbalance or a liquidity void, you can couple all of them together, mark them, extend it through the chart. This was yesterday. So when price came here, I was watching and I was looking at this candle. If it could have closed above, that would negate how am I saying, the entry. So when I saw this and it was in alignment with the time that I trade, going straight into the 1 minute. Whenever price approaches your zone, go into the 1 minute chart. So as you can see, price came, went, took out this high. What is this? This is a breaker, high, low, high, high, inside a fair value gap. Those are some of the strongest algorithmic price delivery. So we had this low taken out, shift in market structure right there, and then price came into the gap and touched the lower end of the fair value gap. So two consecutive candles inside the breaker and also inside the imbalance. Those are 3 PDRAs right there. So we had a breaker block, order block, fair value gap, and the imbalance itself for the 15 minute. So when price came in, you were supposed to go short right there. So this was where we were going short. As you can see, this was a 9-hour trade. What could we be aiming for? These lows first, this is the long hanging fruit, and eventually we had some lows right here, which were nailed right there. So this was a good trade for the silver bullet, and yeah, that's it. So I guess today you have learned something. That was nice and quick. Here we had something nice, could have traded that. So whenever you see a high being violated, you could, it is not always for those people who are trading a break and retest, they could see this as a break and retest to continue going higher, and the market came crashing on them. So you should see the signature that price has left. Like for instance, price came down, took out this low, but did not take out this low. So what is that? That is price lending its hand to you. It's tipping its hand to you, showing you that it's just going up to go down. So for you, you should be seeing this as an entry, as a smart money reversal. So we're going for higher prices, selling at higher prices, and buying at lower prices. So that is what basically happens. So whenever you see a low not being violated, just know that price would want to come back there, because retail will treat this as support. They will drop. For example, if I'm to take a line and put it there, you see price was respecting this area, broke, retest, went up, came down, back again, and then went up. So they'll think that if it comes down, this is the last time it's going to come down and move up. But what did it do? It came down, crashing on everyone, and then reversing and moving low. So you should be able to see this, and for you to see this, it takes time. Showing up every day, reading the tape, seeing what price does, every move price makes. You're looking at it live, so that you may train your eye, you may train your mind, that if you see it real time, you will be able to tell what is the next move, because we're very thankful that these markets are rigged, because it means we can read whatever they are doing. This is not selling and buying pressure. This is absolute control, especially something like gold. These are very highly manipulated market. So if you like to trade something that is we call it a gentleman's market, you go trade with the futures, which is the E-mini S&P and the E-mini Nasdaq, which not every part of the world trades that, because it's meant for the US citizens. So if you are trading, you want to trade the indices, you either go for the NAS 100, US 500, or the SPX 500. So yes, those were the trades. Of course, we had some trades on GU. On GU, we had same trades, but sometimes you might find one pair will move more than the other, so you have to know that before you even execute on that trade. You can do both of them because they happen to do the same thing mostly, but sometimes they differ a little bit, but mostly they move in tandem, they move together. So for you to really get good at this, you have to show up every day. You have to back test, see what price did. For example, what we just did there is what basically backtesting is. Okay, I'll teach about backtesting later, maybe in the weekend, but backtesting is basically what we just did right there. See why did price react to that zone? Why did it reverse? Those are the questions that you should ask yourself. And what is the time did it happen? So mostly you'll find that it happens during the kill zones. So you have to frame your entries in between the kill zones. So yeah, that's probably it. I guess I don't have something to add. So let me show you something. So this is a trade that is currently going on. I sent this to my Telegram group. As you can see, what I just said right now, you see that price came down, did not take this low, came down again, and here rallied up, taking these highs, and then went lower. So the reason why I took this trade and sent it as a signal to my Telegram group, you see it came from this. This is a good trade. This is the one that I just showed you. Came, took the buy side right there. This high got taken out. So what do? You look for reversal, which is basically the 2022 mentorship setups that we'll be looking for. So as I saw, this was I went short right there. But for you either wait for a fair value gap, then enter within the fair value gap, or because these are the signatures that shows that price wants to go down. It may not be going down as fast as you should expect. Sometimes it will chop around, and then eventually it will break lower. So you have to have the power of holding onto trades. So this was a good trade. As you can see, this is a 9-hour trade. As price came here, you should be selling there, stop loss being above there, and hold till you take out these lows, which I believe we are going to take the lows before the close of the New York session. So today it was quite a fruitful day. What I just told you is I just taught you bias. Today, if you really listen to whatever I just said, that's pure bias. Looking for algorithmic price deliveries within a very specific window of time, and yes, that's probably it. So I guess I'm done. If you have any question, maybe you could comment down below, and I'll get to you and maybe help you. Yes, so those were the trades, and tomorrow is on Thursday, and then we have the NFP. So we'll do a review on NFP and I'll be showing you how to trade NFP. So I think this will be the last non-farm payroll event. So because the year has come to an end. So what I'd like to say is whenever you see a fair value gap takes precedency over any PDRA. What do I mean by that? If 90% of the time price reacts to a fair value gap more than any other thing. So for instance, like here in gold, it reacted to that, consolidated, and then moved lower. So anytime you see a fair value gap, either you take your portions right there, or your targets be placed at the fair value gap. As you can see now, price has reacted to this, and as I have told you, low to high, this dealing range, this fair value gap is at discount. So it's quite permissible for price to kind of come down to that point and then reverse. So I guess that's all, folks, and until I see you next time, be safe.